What if I told you that almost every trading mistake you make, every emotional decision, every late exit or impulsive entry has its roots not in your strategy, but in the way your mind is wired to react under pressure? Imagine you're staring at your screen. The market surges and your pulse jumps. You don't even realize it, but your hand hovers over the mouse, ready to click. Before you know it, you've entered a position. Was it your system or your instinct that took the trade? Kahneman calls this System 1. Fast, automatic, emotional. In trading, this is the part of you that's always trying to take control when the pressure rises. You are not alone. Every trader, no matter how seasoned, has moments when instinct drowns out reason. System 1 evolved to keep us safe, to let us react to threats instantly. In the jungle, that was life-saving. In the market jungle, it's a different story. You find yourself cutting winners short, chasing after missed moves, or doubling down when you see a can't-miss setup. Have you ever broken your trading plan because of a red candle? That's not a rhetorical question. It's the story of every trader caught in the heat of the moment. System 1 thinking doesn't weigh probabilities. It leaps to conclusions. It recognizes patterns, even where none exist. You see a rapid drop and your gut screams, "This is the big one! Get out!" Or the price rips higher and System 1 shouts, "Buy now or you'll miss it." This is why you overtrade, why you revenge trade, why you abandon your edge when you need it most. Trading educator Mark Douglas famously warned, "You're not trying to win every trade. You're trying to execute your edge over a series of trades." But System 1 doesn't care about edge. It cares about now. Douglas, Brett Steenbarger, Jared Tendler, every major voice in trading psychology echoes this warning. Your automatic reactions are the enemy of discipline. But here's the harsh truth. You can't turn System 1 off. You can only become aware of it. In the chaos of the market, your instincts are working against you, unless you force yourself to slow down, question your gut, and make space for reason. In the book, Kahneman gives the example of a firefighter who knows the floor is about to collapse, sensing danger before the evidence appears. But you are not a firefighter. In trading, your instincts betray you more often than they protect you. The market's randomness punishes hasty decisions. System 1 thrives on stories, on familiar shapes, head and shoulders, double bottoms. This time it's different. Yet how many times have those familiar patterns ended in disappointment? Ask yourself, how many times have you ignored your stop, hoping for a bounce, only to watch your loss double? That's not logic. That's System 1 clinging to hope. The most dangerous words in trading are "this time is different," and they almost always come from the fast, emotional brain, not the slow, deliberate one. It's not just about fear. Greed, FOMO, excitement, all stem from System 1. Every time you hear yourself say, "I just felt it was going to move," know that you're acting from instinct, not process. Your job isn't to predict. You're here to execute, as Mike Bellafiore drills into new traders at SMB Capital. Yet, how often do you let your reflexes take the wheel, especially when the market moves fast? So what do? The first step is awareness. You must learn to recognize when System 1 is driving your decisions. Notice the urge to act quickly, to chase, to fixate on a single candle. The best traders build a pause, a mental circuit breaker between feeling and action. That pause is the difference between gambling and trading. Here's the challenge. This week, catch yourself every time you feel the urge to act instantly on a trade. Write it down. Ask, is this my plan or my instinct? The more you recognize System 1, the more power you have to override it. Don't kid yourself, your instincts won't disappear. But you can learn to work with them, to pause, to question, and to bring your best self to every trade. Remember, trading under pressure isn't about being fearless. It's about seeing your own mind at work and refusing to let your instincts make the rules. You already know how easily instinct takes over in the heat of trading. But if you want to break the cycle, you have to learn to harness the second system Kahneman describes. System 2, your slow, deliberate, rational mind. This is the part of you that weighs probabilities, calculates risk, checks your trading plan, and holds yourself accountable. Yet in the chaos of the market, System 2 feels slow, effortful, even unnatural. But make no mistake, your long-term edge depends on your ability to deliberately shift from automatic reaction to conscious reasoning. Think about your most disciplined trades. The ones where you waited for your setup, sized correctly, and followed your exit strategy without flinching. Those weren't System 1 trades. Those were System 2 moments, intentional, measured, almost mechanical. You weren't hunting for the next adrenaline rush. You were doing your job. Discipline is the bridge between goals and accomplishment, Jim Rohn said. In trading, discipline means slowing down, stepping back, and letting your rational mind lead. Kahneman warns, though, that System 2 is lazy. It prefers to let System 1 do the work unless forced into action. You know the feeling. You tell yourself you'll analyze the chart one more time, check the economic calendar, run your numbers. Then you just go with your gut because it's easier. That's your default setting. System 2 requires energy, and your brain would rather conserve it. This is why so many traders fall back on habits, even bad ones. But here's the wake-up call. Trading doesn't reward comfort. It punishes autopilot. Jared Tendler puts it bluntly, you must make thinking deliberately a habit. That means creating routines, pre-market prep, checklists, written plans, even alarms to force yourself to slow down. It's tedious, it's repetitive, but it works. Your job isn't to outsmart the market, it's to outdiscipline your own impulses. System 2 shows up when you analyze a trade, not just by glancing at a chart, but by asking, what's my real risk here? What's the probability? Where's my stop? Am I trading my plan or my feelings? It's the voice that says, wait, let's double check. Not the voice that says, you're missing out. Bellafiore tells new traders, preparation equals confidence. In other words, the more you lean on routines and reason, the less you leave to chance, and the less power System 1 has to sabotage you. But don't expect System 2 to save you in the heat of battle if you haven't trained it in the quiet moments. Just like an athlete, you need reps, visualization, review, journaling, all tools to program your rational mind so that when the time comes, you can override panic with process. Write out your trading rules. Print them. Say them aloud. When you feel yourself rushing, force a reset. Stand up, take 3 breaths, check your checklist. Kahneman's research makes it clear. You can't eliminate bias or emotion, but you can design processes to keep them in check. Use your rational mind to build friction between impulse and action. The best traders create obstacles, hard stops, order limits, predefined entry signals, anything to give System 2 a fighting chance. Personal reflection. Think back to a time you followed your plan to the letter, even when it was hard. How did it feel? That's the feeling of real control, not over the market, but over yourself. Douglas said, "You create your results, no one else. The only way to create consistent results is to make deliberate thinking your default. It's not glamorous, it's not easy, but it's the difference between gambling and trading. So here's your next step. Before your next session, script your entire trade in advance. What will trigger your entry? What must happen before you add size? Where is your exit, win or lose? Make it impossible for System 1 to sneak in. When you're in the trade, read your plan out loud. Anchor yourself in reason, not emotion. Your edge isn't in your predictions, it's in your process. System 2 is your weapon against chaos, but only if you force yourself to use it every single day. You might think you're evaluating each trade on its own merits, but the reality is that your brain is constantly grabbing onto anchors, numbers, prices, past highs or lows, that quietly shape your judgment. Kahneman's research on anchoring and adjustment reveals that even random, irrelevant information can sway your risk assessment and execution. In trading, this is deadly. When you become fixated on a recent price, a news headline, or even a previous trade's outcome, you begin to warp your perception of value and risk. Consider the last time you hesitated to close a losing trade because you were anchored to your entry price. You told yourself, it'll bounce back, I just need to get to break even. Or maybe you anchored to a recent high, convincing yourself that the price will return there simply because it once was. This isn't rational analysis. It's the anchoring effect steering your decisions. Kahneman writes, "The influence of anchors is everywhere, and nowhere is it more obvious or more dangerous than in trading." You see it in the chat rooms, the Twitter feeds, the endless barrage of analysts calling for price targets. The market hits a round number, 10,000, 20,000, and suddenly that number is in every trader's mind. Price action clusters around these levels, not because of fundamental value, but because everyone is anchored there, consciously or not. Bellafiore warns traders, don't trade your P&L, trade the setup. Yet, when you're fixated on a target or entry, your P&L becomes the only thing you see. Anchoring doesn't just distort your exits, it can poison your entries too. You miss a move, then anchor to the price you should have gotten. Now, every pullback feels like an opportunity, regardless of the broader context. You start chasing, ignoring your rules, trying to make the market give you what you think you deserve. Mark Douglas called this emotional attachment to price, the silent killer of objectivity. And it's not just the numbers. Anchoring creeps into your strategy selection. You read a story about a trader who made a killing on a breakout, and now you anchor to that narrative. Suddenly, you're taking every breakout blind to the reality that most fail. The market is not obligated to do what you expect, Douglas said. But anchoring convinces you that it is, because you've latched onto a single outcome. Kahneman's classic experiment, where participants guessed the percentage of African nations in the UN after spinning a random wheel, shows how arbitrary numbers can anchor the mind. In trading, that random anchor might be yesterday's close, last week's high, or even the price you saw when you first opened your platform. Your adjustments, your risk, your very perception of opportunity are all filtered through this bias, often without your awareness. So how do you break free? First, admit that anchors are everywhere. Your job isn't to eliminate them, but to spot them before they take over. Before each trade, ask, am I anchored to a number or am I reading the market now? Use multiple timeframes. Write down your real reasons for entry and exit. Force yourself to justify decisions based on evidence, not hope. Jared Tendler recommends, focus on process, not outcome. When you catch yourself anchored to a number, stop and reassess your plan. Did your thesis change? Or is your ego trying to claw back a loss? Create a checklist for exits. What would you do if you had no position? Would you enter here? Or are you just anchored to your entry? Practical action. Next session, track every time you hesitate because of a price anchor. Call it out. Share it with your trading buddy. The more you expose these anchors, the less control they have. Remember, anchoring is invisible, but its impact is real. If you let price fixation shape your trades, you surrender control to randomness. To regain your edge, trade your plan, not your anchor. You're not just reacting to numbers, you're weaving stories. Every candle, every piece of news, every market move, your mind scrambles to create meaning, to explain what's happening and why. Kahneman calls this the illusion of understanding. Your brain's relentless urge to connect dots, to build narratives that give you a sense of control, even when there's none to be had. In trading, this illusion is both comforting and corrosive. Have you ever convinced yourself you knew the reason for a rally? It's because of the Fed, you tell yourself, or it's just profit-taking after a run. The truth? Most of the time, you have no real insight into the actual forces moving the market. Yet your mind insists on filling in the blanks. Kahneman's research shows that humans hate randomness. You crave stories, cause and effect, patterns, meaning. The market, though, cares nothing for your stories. It moves on probabilities, not narratives. This illusion isn't just harmless self-soothing, it's dangerous. You become attached to your story. If the market moves against you, you rationalize. It's just a shakeout. The real move is coming. You double down, adding to losers, ignoring stops, certain that your narrative is right and the market is wrong. Mark Douglas warned, anything can happen. But when you're trapped by your story, you're blind to new information. Compare this with the approach of traders like Brett Steenbarger and Jared Tendler. They urge you to focus not on stories, but on data, on process, on real-time adaptation. When you become a narrative trader, you stop seeing what's actually happening. Instead, you cherry-pick evidence to fit your expectations. Kahneman gives the chilling example of how easily experts, even seasoned professionals, confidently build elaborate explanations around pure randomness. That's the illusion of understanding at work. Have you noticed how after a big move, the financial media instantly creates a reason? But the same news can send the market up one day and down the next. The story isn't real. It's just a frame your mind uses to feel safe. And in trading, safety is seductive but false. Your job isn't to make sense of every move. Your job is to follow your edge, your plan, regardless of the latest narrative. There's a quote from Kahneman that cuts to the heart. What you see is all there is. In other words, you build your story from the tiny slice of information in front of you, ignoring everything else. This is how you miss warning signs. This is how you get blindsided. It's how traders get overconfident, thinking they've figured out the market, only to lose big when reality refuses to fit the story. So how do you escape this trap? Start by embracing humility. Admit you don't know why the market is moving. Admit that your story might be wrong or irrelevant. Mike Bellafiore tells his traders, be agnostic to your thesis. Trade what's happening, not what you think should happen. The market rewards flexibility, not storytelling. Practical exercise. The next time you find yourself building a story, it must go up because X. Pause. Write down the actual facts. What is price action telling you? What does your process demand? Ask yourself, would I still take this trade if my story was wrong? If the answer is no, you're trading the narrative, not the setup. This is where real discipline begins. The best traders don't need a story. They need a plan, a process, and the humility to admit when they're wrong. As Douglas put it, accepting uncertainty is the secret to trading success. Don't fall for the illusion of understanding. Trade the market in front of you, not the story in your head. If you've ever found yourself staring at a red number on your screen, heart pounding, hoping for a miracle bounce, you already know the force of loss aversion. Kahneman proved something every trader feels in their bones. The pain of losing is about twice as strong as the pleasure of winning. It's not just a feeling, it's a fundamental wiring in your brain. In trading, this imbalance becomes your greatest psychological hurdle. Think back to your last loss. Did you follow your stop? Or did you move it just a little, rationalizing that the market would turn in your favor? That moment of hope, the desperate clinging to the chance of getting even, is loss aversion in action. The research is clear. When faced with a sure loss, your instincts drive you to risk even more just to avoid feeling the pain. And yet, when you're sitting on a small profit, you can't close fast enough, eager to lock in that fleeting sense of victory. Cut your losses short, let your winners run. Every trading book repeats this, but why is it so hard? Kahneman's work answers. You don't see losses and gains equally. Every dollar lost stings. Every red candle feels like a threat. That threat triggers your System 1 response: panic, denial, bargaining. The market becomes personal, and your trading plan flies out the window. Compare this with Douglas, who urges, you must accept risk. The moment you put on a trade, you must accept that it can be a loser. This is where so many traders falter. They want certainty. They want to avoid pain, so they break their rules. They average down. They widen stops. They pray. But in doing so, they invite even more damage, turning small, manageable losses into catastrophic ones. You may believe that your logical mind can overcome this, but Kahneman's experiments show that loss aversion is deeply rooted, automatic, powerful, and resistant to pure logic. When you see a loss on your screen, your brain interprets it as a threat to your very survival. This is why you hold losers too long and take profits too quickly. The market punishes both behaviors ruthlessly. Let's get practical. If you want to conquer loss aversion, you must face it head on. Start by redefining what a loss means. Instead of seeing it as failure, see it as feedback, information about your process, not your worth as a trader. Your job isn't to be right. As Bellafiore insists, your job is to execute your edge. Losses are part of that edge. If you cannot accept small losses, you will never see big winners. Action step. Review your last 10 trades. For each, write down how you felt when facing a loss. Did you act according to your plan, or did you let the pain of losing dictate your choices? Then, commit to one thing: honoring your stop, no matter what. Make it non-negotiable. Treat it like a seatbelt. You wouldn't drive without it. Jared Tendler teaches traders to normalize the pain of loss. That means accepting that losing is inevitable, even healthy, if it keeps your risk in check. Repeat it. Losses are normal. Losses are data. Losses are not the end. The harsh reality is this: until you accept the pain of loss, you will always be hostage to your emotions. The market will exploit your fear again and again. But the moment you accept loss as part of the game, you become dangerous. You regain control. So ask yourself, right now, am I willing to feel the pain, to take the small hit in order to stay in the game? That's the real test of a trader. Not who wins the most, but who manages their losses best. You look at your track record, recall a few winning trades, and suddenly you're certain you have a knack for picking tops and bottoms. You can read the market. But here's the brutal truth. Overconfidence is the most seductive and the most destructive bias in trading. Kahneman exposes this illusion mercilessly. You remember your successes, forget your mistakes, and convince yourself that you can predict what comes next, even when the market is inherently unpredictable. Ask yourself, how often do you increase your size after a winning streak, only to watch the market take it all back? That's not skill, it's overconfidence at work. You're not alone. Every trader has felt that rush after a good trade, the certainty that the next one is in the bag. Kahneman's research shows that this isn't just optimism, it's a cognitive trap. Your brain systematically overrates your ability to foresee outcomes, and in trading, that's a recipe for disaster. You might think, I'm just riding momentum, I have an edge, but the edge is never as large as you imagine in the heat of the moment. You are only as good as your last trade. Mike Bellafiore reminds his traders, driving home the point that the market owes you nothing. Yet, your mind craves certainty and rewards. So after a run of success, your risk discipline erodes. You take trades outside your plan, size up too quickly, or start seeing patterns that aren't really there. Consider this. Kahneman cites countless studies where experts, doctors, lawyers, even seasoned analysts demonstrate far more confidence in their predictions than their actual hit rates justify. Trading is no different. You see a setup, recall the last time it worked, and leap in, convinced it will play out the same way. You ignore the context, the changing market conditions, the hidden risks. Overconfidence whispers, "You've got this. Go bigger." Compare this to Mark Douglas's warning, "The market can do anything at any time." That's not just a reminder of randomness, it's a challenge to your ego. The moment you believe you know what's coming, you stop respecting risk. You start managing for the win, not the process. Overconfidence turns your trading plan into a suggestion, not a rule. You might even start trading larger after a few wins, thinking your hot hand will continue. It's the gambler's fallacy dressed up as skill. Losses that follow aren't just financial, they're emotional. You feel betrayed, confused, and angry because you believed you had control. Jared Tendler calls this illusion of control bias. The market lures you in with just enough positive feedback to inflate your confidence, then snaps back to reality. The best traders know this and design their routines to keep their egos in check. They focus on process, not predictions. They journal every trade, analyze every error, and never let one win, or even a string of wins, justify breaking risk rules. So how do you fight overconfidence? First, acknowledge it. No one is immune. Create accountability. Share your trade plan with a peer or coach. Write down your assumptions before entering a trade. Afterward, compare your reasoning with the outcome. Did you see the full picture, or just what you wanted to see? Action step. For your next 10 trades, write down your confidence level before each one. Rate it from 1 to 10. Then, after the trade, review your result. Was your confidence justified or inflated by recent wins? Over time, this practice will expose the gap between feeling and fact. Remember, your job isn't to predict. It's to prepare, to execute, and to protect your capital. Overconfidence is a mirage, and the more you chase it, the farther you drift from consistency. Respect uncertainty. Stay humble, stay curious, and let your results speak, not your ego. The moment you're faced with uncertainty, your mind flips. Kahneman's prospect theory reveals something every trader needs to hear. You don't treat gains and losses equally, not just in emotion, but in risk-taking. When you're up, you play it safe. When you're down, you gamble. Your brain doesn't calculate risk logically. It tilts the table, nudging you toward reckless choices when you're losing and making you overly cautious when you're winning. Think back to a time you were up for the day, maybe hitting your profit target early. Did you find yourself tightening stops, scaling back, or even walking away? Now, remember a day when you were deep in the red. Did you double your position to get back to zero or take a wild, desperate swing? That's prospect theory, alive and well in your trading. Kahneman's research shows how the value function works. When you're in the domain of gains, the pain of giving back profits looms large, so you lock in small wins. But when you're in loss territory, your tolerance for risk explodes. You're suddenly willing to risk far more to avoid taking that loss, even if the odds are stacked against you. Most traders are risk averse with profits and risk seeking with losses, as Douglas repeatedly cautions. But here's the real danger. This psychological flip doesn't just sabotage individual trades, it corrupts your entire trading plan. You start making exceptions. You move your stop just this once. You pass on valid setups because you're protecting profits. Or you size up irresponsibly when behind, thinking one good trade will fix this. It's the oldest story in trading, and it ends the same way every time. Inconsistency, emotional swings, and eventually blowing up. Compare this to Tendler's approach. He urges you to detach from both wins and losses, to see each trade as a single event in a long series. Your edge only plays out over many trades, he says. But prospect theory pulls you in the other direction. It screams, fix it now, don't lose, making you a slave to the moment instead of the plan. The financial world is full of these stories. Bellafiore tells of prop traders who risk it all to avoid closing a red day, turning manageable losses into career-ending disasters. Kahneman gives examples of how people, not just traders, make terrible decisions when facing loss, betting the house, clinging to hope, refusing to cut bait. The practical lesson? You need rules that don't bend when you're losing. If you find yourself changing risk parameters mid-session, stop. That's not flexibility. That's the trap prospect theory sets for you. Write your risk rules before the session begins and stick to them. If you're up, don't get soft. If you're down, don't get wild. Make each trade independent of your P&L. Here's an exercise. After every trade, ask yourself, would I make this decision if I were at break even? If the answer is no, you're not trading the market. You're trading your emotions. Remember Kahneman's warning. The mind is not rational under risk. You have to build processes to protect yourself from yourself. You will never eliminate these tendencies, but you can learn to override them. Use checklists, use reminders, reflect daily. Accept that trading well doesn't mean winning every day. It means making the same good decisions regardless of outcome. You're not here to play it safe when you're up or to bet the farm when you're down. You're here to execute your plan over and over and let the probabilities take care of the rest. You don't just react to the facts in front of you. The way those facts are presented can change everything. Kahneman's framing effect is a silent puppeteer, shifting your perception of risk and opportunity with a single tweak of language or context. In trading, this means the difference between sticking to your plan and blowing it up can come down to something as simple as how you see a loss or how a trade is described in your chat room. Have you ever noticed how a 10% pullback sounds terrifying, while a buying opportunity sounds exciting, even if both describe the same event? Your decisions aren't just shaped by the numbers, but by the story and spin attached to them. The brokerage platform flashes, "You're down $500 in red," and you panic. But if it says down 2%, well within plan, you shrug and manage rationally. This isn't trivial. It's the framing effect hijacking your judgment. Kahneman's experiments showed people make wildly different choices when the same probability is described as a gain versus a loss. In your trading, this means the way you mentally frame a stop out, a win, or a missed move can alter your discipline. When you think, "I lost $200 on that trade," you may become hesitant or revenge-seeking. But if you say, "I paid $200 for market feedback," you frame the same result as tuition, not failure. One mindset builds resilience, the other resentment. This is where discipline is forged or broken. Douglas teaches that you create your experience by how you interpret events. That's framing in action. The more you see a trade as just one of many, the less you personalize every outcome. The more you frame losses as costs of doing business, the less likely you are to spiral emotionally. But the market loves to manipulate frames. News headlines scream plunge when the market drops, creating panic. Yet when the same move is healthy consolidation, traders stay calm or even get excited. The crowd's mood infects you through chat rooms, news feeds, and even your own journal. Framing effects are everywhere, so how do you guard against them? First, reframe intentionally. When you hit your stop, say aloud, "This is following my process, not a failure." When you see a winning trade, say, "Good execution, now reset." Treat each outcome as a single event, not a statement about your skill or worth. As Tendler urges, detach from outcome, focus on execution. This doesn't mean ignoring results, but interpreting them through the lens of your process, not your profit and loss. Take an example from Bellafiore. When a new trader hits their daily stop, the team celebrates. Why? Because the trader followed risk protocol. The frame isn't, you lost. The frame is, you protected your capital and lived to fight another day. This builds a culture of process over ego. Here's your exercise. Review your trading journal. How do you describe losses and wins? Do you frame missed trades as mistakes or as evidence of discipline? Rewrite at least 5 journal entries with a focus on process, not outcome. Notice how your mindset shifts. Remember, you cannot control the frames presented by the market or others, but you can control your own. The way you frame each trade, each session, each outcome will shape your long-term success more than any technical indicator. You're not just managing risk, you're managing meaning. Reclaim your narrative. Frame your trading life as a journey of growth, not a test of perfection. In doing so, you'll find resilience where others find only frustration. You close the chart, frustrated by a loss, and your mind whispers, I knew this would happen. Or maybe after a big win, you say, I saw the signs, I just knew. This is hindsight bias, the brain's sneaky habit of convincing you that events were predictable only after they unfold. Kahneman warns, hindsight bias is a silent trap that rewrites your memory, erodes your learning, and builds dangerous, false confidence. Think about your trading journal. How often do you record what you really thought in the moment versus what you remember after the outcome is known? Hindsight bias makes you overestimate your foresight. You tell yourself that the signs were obvious, that your next trade will be even easier, that you're learning, when in reality, you're just fooling yourself. This illusion keeps you stuck, repeating the same mistakes. Kahneman studies show that even seasoned experts, doctors, analysts, generals, fall for this mental trap. After a result, you rework your memory to fit the outcome. It was clear the market would rally on that news, you say, even if you were confused or uncertain in real time. In trading, this is toxic. You start to believe you get it, so you skip journaling, ignore red flags, and become blind to the true complexity of the market. Mark Douglas drives this home. Anything can happen. When you think you knew what was coming, you start to expect certainty. You risk more, plan less, and dismiss warnings that don't fit your narrative. The market punishes this arrogance swiftly. How many times have you said, I knew it, only to find yourself caught off guard again the very next day? Hindsight bias doesn't just inflate your ego, it blocks growth. If every loss becomes obvious in retrospect, you never ask, what did I really see? Where was my process strong? Where did I get lucky? Real growth comes from brutal honesty, admitting what you didn't know, what you missed, and where you got it right by accident. Compare this to the approach of Jared Tendler and Brett Steenbarger, who urge traders to review every trade as if the outcome were unknown. Tendler teaches, detach your learning from your results. It's not about guessing right. It's about following process and learning from the reality of uncertainty. Here's how you break the cycle. Journal in real time before you know the outcome. Write your reasons for entry, your expectations, your emotional state. When you review the trade, compare your prediction with the result. Did you really see the setup, or is your mind retrofitting a story? Be honest. Did you trade your plan or your feelings? Another powerful exercise. After a loss, force yourself to identify what wasn't obvious. What could have gone either way? Where did you lack information? This builds humility and adaptability. It also makes your journal a real tool for improvement, not just a record of should-haves. Bellafiore tells his traders, the market doesn't care what you thought. It cares what you did. That's why the best traders are obsessed with process over prediction, and why they study both their wins and their losses with equal skepticism. If you let hindsight bias go unchecked, you guarantee repeated pain. But if you confront it, if you force yourself to see what you didn't know, to own your uncertainty, you build real wisdom. You become less attached to being right and more committed to being better. Your challenge this week, after every session, write down one thing you didn't know or got wrong. Watch as your self-awareness grows and your trading follows. You've seen how every part of your trading mind can be hijacked by biases, by instinct, emotion, faulty stories, and the relentless pressure of uncertainty. But what if you could build a different mindset? Kahneman's work isn't just a diagnosis of our mental pitfalls, it's a roadmap for change. The challenge is turning awareness into action, transforming knowledge of your biases into daily habits that protect and empower you as a trader. This isn't easy. The market doesn't just test your strategy, it tests your self-control, your emotional regulation, and your willingness to be uncomfortable. But here's the truth. Every successful trader you admire, Douglas, Tendler, Bellafiore, has faced and managed the very same biases you're battling. They didn't overcome them by pretending they didn't exist. They built systems, routines, and communities that hold them accountable to rational decision-making, even when their instincts scream otherwise. First, remember Kahneman's central lesson. You can't eliminate bias. System 1 and System 2 will always be in conflict. The goal isn't to become a machine, but to become aware of your own mind at work. Awareness is the first victory. From there, you build routines that favor your rational self. Written trading plans, pre-session checklists, post-trade reviews done honestly with the humility to admit what you missed. Douglas calls this becoming the observer, watching your own thoughts and feelings without judgment so you can choose which to act on. Tendler frames it as mapping your mental game, identifying your personal triggers, and building step-by-step responses for when they show up. Bellafiore builds team culture around process, not perfection. The lesson is always the same. Your discipline is built on structure, not willpower alone. Practical steps. Make self-review a non-negotiable. After every session, write out what went well, what didn't, and what you learned about your own thinking. Celebrate when you followed your plan, even if the trade lost money. When you broke discipline, ask, what bias was at play? How will I recognize it next time? Use process-based affirmations. My job is to execute my plan, not to predict outcomes. Build these habits until they become as automatic as your old destructive ones. Don't go it alone. Seek community. Share your struggles and your growth. Get feedback. Let others hold you to a higher standard. Bellafiore's trading desk, Tendler's coaching clients, Douglas's readers all thrive by making discipline and self-awareness a shared pursuit, not a solitary battle. Your journey won't be perfect. You will slip. But every time you catch a bias at work, every time you pause before acting on emotion, every time you hold to your process despite uncertainty, you're rewiring your trading mind for resilience and success. So ask yourself, what will you do differently, starting today? What habit, routine, or process can you commit to, not for one day, but for every day? Because building a rational trading mindset isn't a one-time fix. It's a daily practice, a long game, and the true edge that separates those who survive from those who thrive. By now, you understand that mastering trading psychology is not about eliminating fear or erasing emotion. It's about building awareness, discipline, and daily routines that guard you from your mind's own traps. Kahneman's Thinking Fast and Slow shows you, with scientific clarity, how every trader is vulnerable to biases. The impulsive system 1, the reluctant system 2, the anchors, the illusions, the pain of losses, the overconfidence, the risky swings under stress, the dangerous framing, and the false comfort of hindsight. But these aren't just obstacles, they're opportunities to build true trading mastery. If you want to trade at your highest level, start where it hurts. Face your losses. Challenge your stories. Notice your anchors and frames. Build routines that slow you down and force reflection. Share your process with others. Learn, adapt, and grow together. Read the sections of Kahneman's book that hit you hardest first. Apply just one new habit each week until rational, disciplined trading becomes second nature. If you found value in these lessons, hit like, leave your thoughts in the comments, and subscribe for more deep dives on trading psychology and strategy. Your journey to mastery starts with a single decision: to wake up, take ownership, and trade your plan, not your fears. Summary. This video has broken down Kahneman's insights, anchoring, loss aversion, overconfidence, and more through the lens of real trading. You've seen how leading trading psychologists echo these lessons, and you've been given practical, actionable steps to level up your mindset. Start with the part that resonates most and put it into practice. Like, comment, and subscribe. Your best trading days are ahead if you do the work.